When you think about trade, you think about what's going on between the U.S. and China. It shouldn't matter as much as it's mattering in the press. Meaning, even if we were to take our tariffs to 25% on the full, call it $520 billion, we're talking about $125 billion between one economy of 13 trillion and one economy of 20 trillion. It doesn't matter that much. I think us trying to reset our relationship with China, trade is yet one part of this discussion, and it's a minor one when you compare it to $200 to $500 billion worth of IP stolen from us every year by the Chinese. So I think the global reset of our relationship has some people on edge, and I think that trade's just one small part of it.
Kyle, I do want to dig in on China with you. I know a few years ago you came with that big bearish bet on China, particularly its financial system. What is the latest on that?
Look, we tend to believe that when you build a financial system, when you grow it 1,000% in 10 years, and you only grow your GDP 500%, you've built a reckless pile of credit that is now beginning to show itself. And as China's, call it fiscal impulse, contracted 5% in the last 2 years, that's what's driving China's decline. It's their attempt at a soft landing. It literally has nothing to do with Trump and tariffs. Trump and tariffs are just maybe putting a little bit of icing on the cake. But when you look at their fiscal impulse contracting, and the ultimate arbiter of China's printing, call it $35 trillion worth of their own currency in the last 15 years, it will be the exchange rate between the Chinese yuan and the U.S. dollar, and that's what we spend a lot of time focusing on.
Hey, Kyle, coming back to the U.S. here, we just keep hearing about a possible recession on the horizon. What do you think about that? Do you see that in 2019? Do you see it in 2020? What would be the catalyst?
Yeah, I think when you think about the net effect of the tax plan, we think about it in the net rate of change of stimulus. So in 2018, this net stimulative effect of the tax cuts were roughly $250 billion stimulus to the U.S. Next year, it'll be roughly $400 billion. And then in 2020, it will be $150 billion. So if you think about the rate of change from this year to next, it'll be plus 150. From 2019 to 2020, it'll be minus 250. And so my opinion is, unless Trump gets a, call it $1 trillion infrastructure plan put into place sometime early next year, that it's almost inevitable that we have a recession in 2020.
Hey, Kyle, Miles Upton here. Do you think the Fed is making a mistake, and what do you make of the current path of Fed policy, at least as they've outlined it? And then, of course, what do you make of what we've heard from Jay Powell over the last few weeks?
I think the Fed is doing a darn good job of trying to thread this needle. There are two things that they're trying to do. Number one, they're trying to get rates up to a level so that they can meaningfully cut them if and when there's the next recession. Typically, when the U.S. enters recessions, we cut interest rates 500 to 600 basis points. Well, when rates are 2.5, you can't cut them 500 basis points. And so I think the Fed's concerned about two things: stimulating at full employment, growing the fiscal deficit at full employment, because when you do those things, you always get inflation. And on the other side of things, I think they're trying to normalize rates so that they can have a few arrows in the quiver for if and when we stumble. And again, if we don't add stimulus between 2019 and 2020, it looks to us like a recession is imminent.
Kyle, it's Julia here. One last question for you before we let you go. What is keeping you up at night when you're thinking about the markets?
I don't think we have enough time on the call for that one, but I think that, from our perspective, I think the geopolitics of all of a sudden Europe, which has really been a place of global stability. You have France on fire. You have Brexit dominating the headlines. You have Italy playing chicken with the EU on their budget. Just to name a few. the survival of the Eurozone actually bothers me the most. And now we don't have positions per se other than, we own the Greek banks. But I think that pan-Europe is in a really precarious situation over the next couple of years, and that actually worries us more than the U.S.-China trade row, because I think we're going to end up solving this one way or the other with China in the next year or two. Europe is an equation that we can't come up with a solution for.